Evening, everyone. Iftikhar here from Click Trading Education. This week, markets were reminded of something traders often forget: macro always wins. Geopolitics, inflation expectations, and energy prices all moved back to the front of the queue. The escalation in the Middle East pushed oil higher, lifted inflation concerns, and that was enough to pressure risk assets across the board. The key question now is simple: are central banks really in a position to ease policy anytime soon? Before we get into it, a quick reminder: this is for educational purposes only, not financial advice. Let's start with the numbers. Broadly speaking, this was a risk-off week. Equities were mixed to lower, S&P slightly down, Nasdaq weaker, Russell flat, but the standout was the FTSE, down over 4%. Metals were hit hard. Gold down over 10%, silver over 15%. That's not a small move. That's positioning getting cleaned out. Crypto followed risk sentiment. Bitcoin down just over 5%. Interestingly, FX showed a bit more resilience. Euro and the pound both pushing higher, and the VIX creeping higher, telling you volatility is quietly building underneath the surface. This is where you really saw the tone of the week. High beta names, Tesla, Meta, Nvidia, led the downside. That's classic behavior when traders start de-risking. It's not panic, it's rotation. Capital moves out of aggressive growth and into safety or cash. Crypto told a similar story, not collapsing, but clearly lacking strong demand. And that's the key takeaway. This wasn't a crash, it was hesitation. This week wasn't about finding the perfect entry, it was about understanding the environment. Markets are now repricing for a different reality. Higher oil, stickier inflation, and central banks that may need to stay cautious for longer. And when that happens, the character of the market changes. It becomes more selective, less forgiving, and poor quality setup get punished quickly. Three key drivers this week. First, geopolitics. The Middle East situation increased uncertainty and raised concerns around supply disruption. Second, oil. And this is important. Oil isn't just an energy story. It feeds directly into inflation, consumer costs, and central bank decisions. And third, currencies and rates. Sterling actually held up well this week, supported by a more hawkish Bank of England outlook. So FX is no longer just reacting to risk. It's reacting to relative policy expectations again. Let's break it down properly. Equities, defensive tone. No strong upside conviction. Metals, weak into the close. Reminder, gold isn't just a safe haven, it's heavily influenced by rates and the dollar. Crypto, still tied to risk appetite. If equities struggle, crypto struggles. FX, more balanced, not one-way dollar strength, more nuanced positioning. And this is where traders need to be sharp. Different asset classes are telling slightly different stories. Simple message this week: macro changes the playing field, but your process keeps you in the game. This is where a lot of traders go wrong. When markets get noisy, they abandon structure and start trading opinions. That's usually where consistency disappears. Our approach stays the same. Let the environment shape expectations, but let your process drive execution. Next week isn't packed with data, but what we do have matters. Tuesday, flash PMIs. If growth weakens while oil stays high, markets may start pricing stagflation risk. Wednesday, UK CPI. This is a big one for GBP pairs. Thursday, Fed speakers. In this environment, even commentary can move markets. Friday, US consumer sentiment. Watch for the impact of higher fuel costs feeding into the consumer. So overall, not heavy on data, but high on potential impact. Here's how we're approaching it. Indices. Be cautious on upside. Look for quality, not quantity. FX, GBP pairs worth watching around CPI. Gold, don't oversimplify it. Watch the dollar and real yields. Oil, still the key driver. This is the market setting the tone right now. Crypto, entirely dependent on risk sentiment. And overall, trade the environment you have, not the one you want. Final thought: markets don't move in isolation. Politics affects oil, oil affects inflation, inflation affects rates, rates affect equities, and everything affects sentiment. That's why having a structured plan matters. You don't need to know everything. You just need to know what matters most and when. Trade well this week. Stay disciplined and don't let a headline-driven market turn you into an emotional trader. If you found this useful, like, share, and subscribe. And if you want to learn how to build a structured trading approach properly, check out Click Trading Education. Thank you for watching. And this is IFTY signing off this week.